Hey guys, hope you're doing well. And now we're going to get ready to conclude the broader topic of what equilibrium in a perfectly competitive market means. So we've talked a lot over the several, 10, 12 videos, what it means to be in perfect competition, that they are producers and both consumers are price takers. They cannot do anything about the market price. We've talked about how you measure profits in relation to the costs, what causes the cost to go up, what's a short-run decision, what's the long-run decision. Some of the important equations and formulas probably went by the screen as I was talking. Make sure you're comfortable with that. And then we also talked about what it means to be in equilibrium. So now we're going to talk about what it means for a perfectly competitive firm to be in equilibrium when we talked about their production decision several videos ago. So hopefully you're clear with all of that information. So we're going to stick with the same example. We're assuming that our producer, our baker, is operating in a perfectly competitive market, right? So they cannot change the price. The price is given to them. So I'll give you some of the conclusions and I'll do a detailed example with you. So hopefully that'll clarify some of the things. So let's look at the two scenarios. If a producer is earning some positive economic profits, that's going to lead to some entry because it's a perfectly competitive market. When firms enter, it increases the supply, which lowers price, and price will be lowered until we get to zero economic profit. And conversely, if the firms are earning some losses, it's going to lead to exiting, certain firms exiting, because it's in the long run. Now we are looking at long run, right? So when everything is variable, we can get rid of all our costs and exit the market altogether. For the existing firms, profits will go up, price will go up, leading to zero economic profits. So this is the conclusion, and you'll see it when I do the example how we get there. So at the end of that process, entry and exit, economic profits are going to be zero. I'll talk briefly about what economic profit is in the next slide, which means in the end, and you'll see this on the graph when I draw it, we know that MC always equals MR, right? If a firm is being efficient, we also know in perfect competition, MR equals price. So that we know from before that P equals MC equals MR. Now what's new here is that in the long run, all of that is also going to equal ATC. So in the long run, where a perfectly competitive firm produces the quantity, all of them are going to be equal. And again, you'll see it in the graph in just a second as well. And I've already described what efficient scale means. You'll see that if we operate at the minimum point of ATC, that's where the producer is going to be in the long run as well. All right, so, and you'll see that in a couple of slides as well. So what's the difference between economic and accounting profit? So accounting profit is what the average person looks at, revenue minus costs. The difference in terms of economic profit is we take into consideration implicit costs. Now, I very briefly would explain what that is. Implicit costs are costs that does not require a direct outlay, but it's a cost, it's an indirect cost because we are losing money because we're not getting something. So for example, if I'm deciding to quit my job and start my own business, so my costs, explicit costs, are costs of starting the business. So let's look at an example. Let's say I'm I'm going to quit a job and start my own business. So explicit costs are costs of running that business. Like, I might need to rent a place, I might need to buy some equipment, hire people. Those are all explicit costs. Those are costs that I'm going to pay when I'm hiring those inputs. Implicit cost is the cost that I'm, giving up to start my business. So the earnings that I was earning when I was working at a job is my implicit cost. So when we look at economic profits, we take into consideration both explicit cost and what else we could have done with our time. In this case, working at my previous job. So economic profits looks at both of those costs. All right, it's the opportunity cost of what else I could have done if I did not choose to run my own business. All right, so zero economic profit is not necessarily a bad thing. It's a good thing, which means you've already taken into consideration your next best alternative, which in my case was the salary that I'm getting from my previous job. All right, so now let's look at a detailed graphical example, and I'll look at one of the scenarios where the firm is earning either a profit or loss, and then hopefully you can work with the other scenario as well. So let's say we are drawing the market for whatever good you think is in a perfectly competitive market. We have the demand curve, we have the supply curve. There's nothing here that should be new. Now we know this is the equilibrium price, and this is the equilibrium quantity in the market. Now when we go from looking at the market to the firm, now again we have quantity, we have costs and profits and price, everything on the vertical axis. I'm not going to draw all the lines here. I'm going to draw the relevant ones. So let's say this is your ATC. We know your MC has to cut across the minimum of ATC. Let's say that's your MC. So now given that P0, let's say P0 here translates here, right? Let's say this is what P0 from here. So once a producer knows that the market price is P0, that's what they're going to charge. And I'm assuming that's, that number there is the same as this number here. So if that's the case, we know that in perfect competition, price equals MR. And we also know that in a perfectly competitive market, as like in any other market, which we'll talk about later on, the first thing you're looking at is where does MC and MR cross, which in this case equals price as well. So now this is where MC and MR crosses. First thing you do is, okay, what is my quantity? This is your quantity. Then you say, okay, what are my costs? This is going to be a cost. This is your ATC when you produce Q star. And then that region you know represents profits. That I'm not going to go over all of those details from before. You review that video if you're not comfortable in analyzing how you measure profits and losses. All right, so that's what happens in the short run. What do you think is going to happen in the long run? When in a perfectly competitive market, under the assumptions we made about that market, if a firm is earning profits, as they are in this graph, other firms will enter the market. When they enter the market, this is the market, supply goes up. When supply goes up, the price in the market goes down. When the price goes down, I'm going to just assume, I'm going to get to the point where I want to, P1 is going to, the firms will continue entering until price goes down to the level where the new intersection happens. I call that P0 and M0 because that's what I called it there. Now, what we see here is that at that P and MR, MC cuts across MR at this point. Right, so now at that point, at that quantity, I'm going to call that Q star star. This is your ATC because you see it's intersecting at the minimum point of ATC. That's the only point where the quantity that you produce is also going to equal price, MR, MC, and ATC. So what I said in the few slides ago, that in the long run, we'll reach an equilibrium where not only does price equal MR equals MC, that we knew from before, but we will also be at a point where all of that equals ATC. So at Q star star, all of these are going to be equal. So this is the quantity that the firm will produce in the long run, and all of these are going to be true, which means the profits are zero. And we know from before that the minimum point of ATC is also referred to as the efficient scale. It's not good or bad, it's just what it's referred to as, and that's where we are operating. So the point here is that if firms are earning positive profits, supply goes up, reducing price until we get to this outcome. Conversely, if firms are earning a loss, some firms will exit the market, decreasing supply because they're exiting the market until price gets to this point. So in the long run, price will always get to whatever I'm calling P1 to be because of entry and exit in a perfectly competitive market. So that's an important conclusion, is that in the long run, we think of the supply curve in the market to be perfectly elastic because of entry and exiting, driving the price always to this point. All right, so work with the other scenario, do an example where a firm is earning a loss and see whether you can recreate all of this and get to the point where we get to all of these outcomes. All right, so hopefully you're comfortable drawing all of this information. And I'm just concluding it here, is that in the long run, typical firm earns zero economic profit. That means that they're going to be operating at the minimum point of ATC. All right, so again, that ATC and MC, you need to know that MC crosses ATC at its minimum, which means that in the long run, the supply curve in the market is perfectly elastic. Right? It's horizontal. In the short run, prices can go up and down below or above the equilibrium, but in the long run, we get to that point. Right? So hopefully you're clear on that. So that's going to conclude how we analyze producers and consumers in a perfectly competitive market and what it means to be in equilibrium, short run, long run. And in the next chapter, we're going to talk about other kinds of markets where it's not perfect competition.